Hi, so as the title of this video suggests, today I'm going to go through with you how I would start a growth portfolio today. But this isn't just for those people out there who are beginning a portfolio. If you already have a portfolio that you've already been building, well, hopefully you'll be able to add some things to it from my suggestions. But remember, it's your money, so you've got to make your own decisions. So you've come to this video for ideas, which is great, but just remember, you've got to do this yourself. And today I have 4 companies that I think would make a really good, strong core holding of a portfolio. And in my opinion, it's actually the high likelihood of strong, consistent growth over the next 10-year period that I think makes these companies, well, the best 4 companies to invest in right now. And what do you think these 4 companies are? I don't think you're going to guess them. Now, people invest in the stock market all the time, and it's mostly because somebody told them they should. But in my videos, I'm going to try to help you understand what it is you're actually buying. And if you are new to my channel, well, you started at a great video. And if you do like this video, please make sure to like it, subscribe to my channel so you don't miss any of my future videos too. Now, before we jump into the 4 companies, we need to set some ground rules for this video. And the first rule is we have to be thinking long term. If someone was to say to me that I've just bought these companies and that, well, I can't sell them for 10 years, I should be totally okay with that situation. There's actually a lot of empirical research explaining why we need to think like this. And the big reason is we just don't want to overtrade. Because firstly, one of the biggest mistakes that a lot of investors make, especially new investors, is they're going to trade too much. Buying and selling too frequently really hurts your long-term returns because not only are there fees involved, well, you haven't let the thesis of the investment that you made actually come to fruition. Look, and don't just take my word for it, a lot of the billionaire investors all agree. For example, Charlie Munger said, "Big money is not in buying or selling, but in the waiting." Warren Buffett said, "The fruit and shade produced by this tree is only possible because someone planted a seed a long time ago." Peter Lynch said, "Time is on your side when you invest in superior companies." And this is my opinion. So once you're invested, the best thing to do is do nothing. Go start a business, go get a hobby, just let your investments do their thing. Now, the second rule is that we're going to look at the future of the industry that the company is operating in, and we want to make sure that is solid. We want to make sure that the industry is still going to be around in 10 years' time, and even better if the industry is growing. And the third rule is we're not going to look at startups. See, the risk associated with startup style companies is that they haven't been around for 10 years. Therefore, the risk that the company is not going to be around in 10 years' time is higher than a company that has been through, say, a financial crisis or some serious world issues before. And with startups, well, we have to keep going back and looking to make sure the company is performing okay, and we don't want to frequently be looking at our investments. The fourth rule is the company must have strong financials. So we want all of our companies that we invest in to have very manageable debt, some growth, and they're making good management decisions. So the fifth rule is we're actually going to be looking at stalwarts and slow growers. Now, I know that sounds a little bit counterintuitive considering we're building a growth portfolio, but let me explain. See, I could go for more higher growth prospect companies, but what we're trying to do here is we're trying to get growth for a long period of time without having to frequently check on the portfolio. And see, the problem with these high growers, cyclicals, and turnaround companies, well, you really have to be monitoring the thesis. But if you are interested, well, the companies that I would invest in for higher growth potential, but far more monitoring would be these. Now, don't jump into these without extensive research and making sure you really understand the risks involved here. So the companies that I have invested in for higher growth are DHT, TNK, Euronav, and DSSI. Now, these are all oil tanker companies and they're cyclicals. Now, if you don't know really what I'm talking about here, go back and watch my 2-part oil tanker video series where I explain the thesis in a lot more detail. The 5th company here is Unum, which is a life insurance company, and I would consider this a turnaround company. And the 6th company is called Global Cord Blood Corporation. It's a Chinese small cap umbilical cord depository company. Now, I would consider this a fast grower. This has got a lot more risk than the other investments, but again, I have made a video on this where I can explain the thesis. And the 6th and final rule is we want to always have a margin of safety. Buying even a great company at the wrong price will seriously affect your performance of your portfolio. The reason is because when we make valuations, well, we have to use assumptions. And when you use assumptions, well, there's the real prospect of being wrong. Okay, so let's do a comparison. Let's look at Amazon, which is an amazing company. It has a lot of growth prospects and is considered by most people as one of the best growth stocks out there. Now let's compare that with Bank of America, which has okay growth and not really considered a high growth company at all, not even a growth company at all. Now, wouldn't it be great if we knew how to find out what the share price is going to be for each of these companies in 10 years' time? Well, I have a trick to calculate that. Now, of course, we're going to be making a lot of assumptions here, but we're trying to get a bit of a ballpark figure. So let's try to calculate the future price of Amazon. So we use the formula here. It's the future price, which equals the free cash flow per share multiplied by 1 plus the growth to the power of 10 times a fair PE. So I went and grabbed the free cash flow per share number, and a fair PE I'm using is 20, which I think is a fair number in 10 years' time. So the future price of Amazon stock, based on this formula, once I've plugged it all in, is $9,872, about $10,000. And the current share price is about $3,000 or $3,100 today. Now, to go from $3,000 to around about $10,000, it's about a 12% annualized return. Now, that's not too bad, right? That would turn $10,000 into about $30,000, $31,000 in 10 years' time. But one of the assumptions I made is that Amazon has to continue growing its free cash flow at 25% per annum on average. Now, that's really, really high growth. 25% for 10 more years, year on year. That's really hard to imagine, and that's just to get our 12% return. Now let's go compare that to Bank of America. So I've grabbed the free cash flow per share number. Let's use a fair PE of only 15, because that's a bit better for the banking sector in 10 years' time. And we're only going to use a growth rate of 6% per annum. So the future price for Bank of America in 10 years' time, according to the formula, is about $206. With a current share price of $24, well, that's going to be a 24% annualized return. So that would turn your $10,000 into $85,000. So that's more than twice the expected return than Amazon, even though Amazon is clearly growing faster. So it's that discount that we're getting on Bank of America that gives us that superior return potential. So our assumption for Amazon was that they could grow at 25% for the next 10 years. If they don't do that and start to slow, well, our returns could get a lot less. Say from 12% expected return to maybe 8%, maybe only 5% if that 25% growth rate isn't met. If Bank of America slowed from that conservative 6% growth rate, well, our returns might go from, say, that 24% maybe to 18%, maybe at a worst case scenario, 15%. So see how we need a margin of safety so we still can get good returns, because I would be happy with 15%. There is not much room for mistakes from Amazon, but Bank of America, well, we have so much more room to work with to get that superior return. It's a far safer and better money-making opportunity. Now, these 4 stocks are not going to be in any particular order, and I like them for lots of different reasons. And okay, so as you have probably guessed, the first stock in our portfolio is going to be Bank of America. So after the scare of the 2008 financial crisis, Bank of America have built a really strong and lean company that is far better at handling any future crises, especially the one we're in now. Now, the banks make money when the interest rates are higher. So the interest rate environment now being super low has meant that Bank of America has been struggling to make big profit, but that has made them cut costs, which means that when interest rates do eventually start to creep up again, Bank of America are in a great position to make a lot of money. So my thesis is that over the next 10 years, Bank of America will greatly benefit from a return to normal conditions. Yes, they are a slow grower, and they're not an exciting name like Tesla or Zoom or anything like that, but it's why we need to invest in them for the long term. The big reason why I have included it into this growth portfolio is mostly because of the big discount to intrinsic value. Therefore, we're getting a really good margin of safety into a really strong company. Now, what's not to like about Berkshire Hathaway, run by probably the best managers of all time in Warren Buffett and Charlie Munger? They have been doing it now for over 50 years, and it's an incredible story and an incredible company. Now, a lot of investors overlook this company because it's just not the hot stock right now. Now, to say that Berkshire Hathaway is a boring company, well, I just think that's a very amateur statement, because really, how could you possibly be bored with the amazing historical performance that they've been doing for 50 years now, and that the future growth prospects are still really strong, 15% plus? I think of investing in Berkshire Hathaway a little like this. See, it's like getting 6-time Formula One champion Lewis Hamilton to drive in a go-kart race for you in his Mercedes. He has such a big advantage and is one of the best as well. The chance of success here is very high. Berkshire Hathaway gets access to deals that just most of us cannot. For example, the company issued billions of dollars recently into corporate bonds in Japan at practically 0% interest rate. And then they've used the money that they've raised to invest back into the 6% dividend paying safest Japanese companies. This is literally making free money. So their financials are incredibly solid. They continue to grow. They have access to some of the best opportunities in the world, and their management team is also probably the best in the world too. Now, I know these numbers are a little bit similar to the Amazon example that I explained earlier. I just think that Berkshire Hathaway is a far more predictable company, and Amazon having their 25% growth rate to maintain that for 10 years just doesn't seem right. Berkshire Hathaway, in my opinion, is an investment that we can make and we can totally forget about it for 10 years. Another relatively boring company here, with Prudential Financial being a life insurance company for a lot of corporations throughout the world. But I don't think you're going to find the potential returns boring. Now, life insurance is expected to grow significantly over the next decade because a lot of people right now don't understand the importance of life insurance for themselves and their family. And life insurance is a fantastic business model. See, corporations pay every year for their employees to be covered, and that means that Prudential get all of this money every year to invest however they like. And right now they have a huge $1.5 trillion of assets under management. The other positive thing that I found out just recently is actually the switching costs for a corporation to move away from Prudential Financial to one of their rivals is actually quite painful, and it actually requires a lot of work. So the companies that are already with Prudential are probably going to stay for quite a long period of time. Prudential have great financials, they have stable investments, and they have been around for more than a century. But what about their growth potential? See, if we were to look at their free cash flow that they've been generating, well, you'd have to say that they are just severely undervalued. And if you're looking at it from a price to book value perspective, well, they are at least at a 50% discount to intrinsic value. In my opinion, I just don't think it gets much more obvious than this one, and I've been investing in Prudential over the last month, and I'm going to continue to do so. Now, this one is something that I myself haven't invested in yet, because I'm waiting for a price around about $250 because that's what my intrinsic value calculator is suggesting. And by the way, if you want a free copy of the intrinsic value calculator that I use to decide what the right buy price is for a company, well, it's free and it's in the description below. Biogen is a pharmaceutical company that treats a lot of neurological diseases, and they have lots of interesting and new products that they're looking to roll out over the next few years once they've been approved, and I think the future looks really good for the company. But what I really love about Biogen is their financials. Just look at some of these financials. They have a 22% return on assets, 46% return on equity. Their debt is manageable and far better than a lot of their peers. Their gross margins are at a huge 88%. Their net profits margins are also at a huge 40%. And their price to free cash flow is a very attractive 6.65. Now, future growth is going to be the hard thing to predict here. They are in a really strong industry that's definitely going to be part of our future. Biogen has also been around long enough that they've weathered a few storms in the past, and I'm sure they can do that in the future. But some analysts think that growth rates over the next 5 years are actually going to be negative, and I guess this is the concern. So maybe there is a slightly higher risk here, but I think it's definitely worth the investment at about $250 a share. So with a future price of about $1,170 and a current share price of $280, that would get us about a 15% annual return, but it's about 17% if we get that $250 price that I want. So that would turn up $10,000 into about $40,000. So you might be wondering why there's no tech companies here. Where's Google, Facebook, Alibaba? That's where the growth is, right? Even though I love these companies, well, like I explained earlier in the Amazon example, I just don't think we're getting a good enough discount to intrinsic value. Now, I also think that the projected growth rates of a lot of these companies are just too optimistic. I think I'm playing it very conservative with lots of growth potential for Bank of America, Berkshire Hathaway, Prudential, and Biogen. See, I think the likelihood of these companies giving us great returns is very high because they don't have to do anything amazing. See, I think they just need to continue operating their businesses as normal. I would happily buy all 4 of these companies, then forget about them for 10 years, and then I'll check them again. Now, you might be thinking, why no oil tankers because I'm so bullish on that industry? Well, it's because they're a cyclical play. I think we're still going to get significant returns over the next 3 years with the oil tankers, but it's going to take a lot more monitoring and a lot more just checking to make sure the thesis is playing out. And the 4 companies that I showed you today, well, they just require far less thought and are just more stable. So there you have it. That's my growth portfolio for the next 10 years. Now, I've invested in all of these except Biogen because I'm still waiting on that $250 price. All right, so what do you think? What do you think I have missed? If you've made it to the end of this video, please leave a comment and let me know your questions. And if you do leave a question, just say that you watched to the end and I'll make sure that I answer that question as a priority. I hope you enjoyed this growth portfolio, and if you can let me know by hitting that like button, that would be great, and I will see you in the next video.